number 4. You've probably heard the Wall Street maxim, buy low and sell high. Well, that advice applies to finding the right rental stocks as well. Renting stocks is about reducing risk. You've already learned how to offset some of that risk associated with falling stock prices. That is, our rental income serves as a sort of insurance policy that helps offset any unforeseen drop in our underlying stock price. To eliminate even more potential downside risk, it makes sense to identify and purchase rental stocks that are already oversold or undervalued, yet still in good financial shape. Consequently, we look for the following 3 fundamental ingredients in a great rental stock. Number 1, a stock trading near its 52-week low. Number 2, a current ratio of 1 or greater. And number 3, a price-to-book ratio of 1 or less. Let's examine all 3 in depth. The first one, a stock trading near its 52-week low, is the quintessential buy low and sell high strategy. Anytime you look up a stock's current stock price, the information will also most likely include the stock's 52-week high and its 52-week low. Not all 52-week lows are arrived at in the same way. For example, I don't like the following 52-week low. The stock appears to be on a slow downward slide, a trend that makes me nervous. I prefer a different sort of 52-week low, the 52-week plunge. As an investor, this is by far my favorite shape. Whenever I see this shape, I get super excited. Why? Let me show you. This company's stock price is going along just fine when, wham, it drops off a cliff. But it hasn't hit bottom yet. The first wave of bargain hunters starts buying. This increased demand temporarily drives the price up. Wall Street calls this, somewhat morbidly, a dead cat bounce, because even a dead cat, if dropped from a high enough height, will in fact bounce, albeit not very high. We are not part of the first wave of buyers. We want to wait until they're done. Demand dries up, the stock starts to slide downward again, until eventually the residual negative sentiment surrounding the stock slowly fizzles out and a bottom starts to form. We wait while the stock bounces around the bottom for a little while, and then, if our other criteria are met, we venture in and start accumulating the stock. I used the word accumulate because you don't want to go all in at one time. If after a month or so, the stock has been trading flat and hasn't dropped more or risen, you may want to add more to your position. If and when the stock finally does begin its recovery, we will want to begin thinking about renting it. Here are some real-world examples of my favorite shape. However, just because a stock is trading at its 52-week low doesn't necessarily mean it's a good value. There could be a very serious problem with the company that is causing its stock price to drop. For example, a cash-burning biotech company whose only pipeline drug just failed phase 3 FDA approval, or a tech company that failed to foresee the opportunity afforded by the mobile revolution and therefore fell so far behind that its product offerings become irrelevant, might experience even deeper drops in its stock price than its 52-week low. In situations like these, you need to dig deeper before investing in the stock. Before investing in such a stock, you should ask yourself, can the company recover? Has the company laid out a turnaround plan that sounds plausible? Does the company have a history of bouncing back? Does the company have any executives or board members that have experience turning companies around? Are key executives jumping ship? Are key executives buying or selling their own shares? Does the company have enough cash to fund a recovery, or will it need to sell more shares to raise money? For example, if a company has 1 million outstanding shares and decides to issue and sell another 1 million shares to raise money, the company's stock price is most likely going to get cut in half. Why? Well, if you own 10% or 100,000 shares of the company's 1 million shares, then after the company issues another million shares, you now only own 5% of the company. That is, your 100,000 shares divided by 2 million total shares. This is called shareholder dilution. How can you tell if a company has enough cash or must issue new shares and in turn dilute its current shareholders? Well, there is no foolproof way to know. But there is a valuable clue. It's called current ratio. A company's current ratio is equal to its short-term assets divided by its short-term liabilities. It's basically an indication of whether or not the company has enough money to cover its debt obligations over the next 12 months. The higher the current ratio, the better. Think of it this way. Let's say you have $48,000 in your bank account and your monthly expenses are $2,000. In this case, your current ratio would be 2, or $48,000 divided by $24,000 in annual expenses. If you had $72,000 in the bank and the same $24,000 in expenses per year, your current ratio would now be 3. The higher the current ratio, the better. The current ratio is a liquidity measurement. In the last example above, you could continue to pay your monthly bills for 3 whole years before you needed to raise or earn more money. Companies that have current ratios of less than 1 will most likely need to raise more money within the next 12 months. And how do companies raise cash? They issue additional shares, which dilute existing shareholders. And what does dilution do to the stock price? That's right, it drives the stock price down. Remember, we want to buy low and sell high, or in our case, rent high. Therefore, we avoid companies with current ratios of 1 or less, at least until after they dilute everyone else, after the company dilutes its existing shareholders and drives the stock price down. Then maybe we'll take another look at buying the stock. The last metric we look at is the price-to-book ratio. The price-to-book ratio is used to compare a company's stock price to the company's book value. Book value is what the company would have left over if it liquidated all of its tangible assets and paid off all of its liabilities. Tangible assets would be things like cash left in the bank, unsold inventory, any buildings or trucks the company owned, the company's furniture, etc. Theoretically, book value is what shareholders would receive if the company went out of business and were liquidated. I say theoretically because the company's bondholders, if there are any, take priority over common shareholders like you and me. That is, they get paid back first. That said, book value is still a very useful metric for us. It gives us an indication of whether or not the company's current stock price might be overvalued or undervalued. For example, if a stock is trading at $10 per share and its book value is $20 per share, then the company is probably undervalued. Think about it. If the company went out of business today, it would still have $20 per share in leftover assets after everything else was paid off. So a $10 share price might be a great deal. The company's price-to-book ratio would be 0.5, calculated by taking the $10 stock price and dividing it by the $20 per share book value. On the other hand, if a stock is trading at $40 per share and its book value is $20 per share, then the company is probably overvalued. Its price-to-book ratio would be $40 divided by $20, or 2. I should point out that price-to-book value ratios vary by industry. For example, an internet company which owns a few servers and maybe a small office building might not have much in the way of assets. So its price-to-book ratio may appear very high and therefore seem unattractive to us. While an oil company with trucks, ships, oil wells, refineries, etc., will have lots of assets and may appear to have a low price-to-book value. My point is that guideline number 3 above, that a company should have a price-to-book value of 1 or less, doesn't always apply depending upon the industry. That said, the lower the price-to-book ratio, the better, especially when compared to a company's peers. These 3 key guidelines, the 52-week low rule, current ratios of 1 or greater, and low price-to-book ratios are by no means foolproof. In fact, there are many more ratios and fundamental aspects that investors typically take into account before buying a particular stock. That said, these 3 guidelines will certainly mitigate a great deal of risk and serve you well, if you're disciplined enough to adhere to them. Discipline is the key to successful investing. Too often, investors disregard guidelines or rules because they somehow think that a particular company is somehow different. It's easy to convince yourself that a stock is somehow unique and therefore these guidelines don't apply. Quite often, you'll be able to find a seemingly credible stock expert online or on television that appears to be objective and seems to support your reasoning. This is called confirmation bias. Confirmation bias is when you want to believe something is true so badly that you seek out others that agree with you, even when you suspect that the person who is agreeing with you might have some ulterior motive. Disciplined investors don't delude themselves. The facts are the facts. Ignore the guidelines at your own peril. You might be right, but you'll be wrong more often than not. You must be disciplined and apply these criteria to any rental stock you're considering buying. Let's analyze a real-world example. Using Yahoo Finance again, let's look up Walter Energy, ticker symbol WLT. On the left-hand side, click Key Statistics. First, we can see that the current stock price of $10.40 is very close to the 52-week low of $9.88 per share. Next, we see that the company has a current ratio of 1.69, which is higher than our minimum requirement of 1. This means that Walter Energy has enough cash to cover the next 12 months' worth of liabilities, and therefore, the risk of the company selling new shares, diluting us, the shareholder, and ultimately driving the stock price down is low, at least in the short term. Lastly, the company has a healthy book value of $15.12. That's $4.72 per share more than the current share price. Its price-to-book ratio is equal to 0.68, which is well below our requirement of 1. You can calculate Walter Energy's price-to-book ratio yourself by taking its current share price of $10.40 and dividing it by its book value of $15.12. A price-to-book ratio of 0.68 may be an indication that Walter Energy's stock is undervalued. Our conclusion? Under these conditions, Walter Energy is a great stock rental prospect. You can find your own great rental stocks by using a stock screener. Here, I'm using Google Finance's free stock screener to find great rental stocks. In this example, I've set my parameters to find stocks that have fallen 85% during the past 52 weeks, have a current ratio of at least 1, a book value of at least $2 per share, and a current stock price of at least $1. As you begin searching for great stocks to rent to other investors, you will soon discover that less volatile stocks generate meager rental incomes, while very volatile stocks, such as the biotech stocks we looked at earlier, offer enormous rental potential. The reason for this is simple. It's risk versus reward. For example, Microsoft has billions of dollars in the bank, a dominant and entrenched position in the computer operating system market, and no credible threats. On the flip side, the overall market for Microsoft software has begun to plateau, so while it enjoys a near monopoly, its future growth is somewhat constrained. Therefore, Microsoft's stock price is fairly stable and thus predictable. It's this predictability that limits the amount of rental income a person can generate by renting out Microsoft's stock. Contrast Microsoft with a biotech company such as Arena Pharmaceuticals, which has just received FDA approval for its new obesity drug, the first FDA-approved obesity drug in more than 10 years. And in a growing obesity epidemic and rising healthcare costs, you have a potential blockbuster drug that could be as big or bigger than Viagra. Or it could be a dud. Who knows? The point is, nobody knows, and in such an uncertain situation, Arena's stock price, along with its rental potential, are extremely volatile. Stock price jumps of 300%, 500%, even 1,000% are possible within the biotech sector. It's not uncommon to rent out biotech stocks like Arena for half of the original stock purchase price. I've even rented out a biotech for 100% of the purchase price. That's right, even if the company went bankrupt, I couldn't lose. I had recouped 100% of my original investment with one rental. I'll explain how this is possible in lesson number 5, Advanced Stock Rental Strategies. Please take the accompanying quiz to test your understanding of the lesson material we've just covered.